Morning, everybody. Welcome along to another Growth Hub webinar, where today I'm once again accompanied by Joe Tomlinson from Businessworks. My name is Joseph Midgley. I work for the York and North Yorkshire Growth Hub, part of the York and North Yorkshire Combined Authority. I'll hand over to Jo shortly in a second, and she's going to tell us about everything you need to know about owning a business, or at least an introduction to what you need to know, rather. Just a little bit of housekeeping before I hand over to Jo. So this session is being recorded, and you'll all receive the recording and a link to the slide deck by email afterwards. So if there's anything you miss, or if you think this was an absolutely amazing session and you need to share it with all your friends and family, you're very welcome to do so, and that'll land with you when I get around to uploading the webinar later this week. As much as we're being recorded, you won't appear on the recording unless you speak out loud during the session. So I would invite you to all please leave your cameras on, so that Jo has a friendly, warm, receptive audience to speak to. We've got plenty of time in today's session, so if you do have any questions, please do stick them in the chat as we go along, or we can have a time for a bit of a Q&A at the end, and I can always turn the recording off for that part of the session. As I mentioned in the previous ones, Jo also does have some kind of one-to-one hours that we've paid for. So if there's anything that comes up where you say, I wouldn't mind having a bit of a one-to-one chat with Jo about this aspect of my business, stick it in the chat or email me and I'll put my details in the chat box as we go along. But there is an offer of some one-to-one time to go along. I think that's about everything. As I say, keep an eye on the chat box. Let me know if you need anything. And I'll also post some useful links. For example, Joe's written a blog to go on our website that accompanies this one. So afterwards, you might fancy reading that one. So you've got a bit of a guide to follow. I think that's about enough waffling for me. So I'll hand over to Jo, but let me know if you need anything throughout today's session. Over to you, Jo.
Thank you. I am Jo Tomlinson, and today is something that can be considered quite a dry subject because it's talking about what you need to do rather than anything sexy about growing your business. So I do apologise for that, but it is stuff that we need to know. So for anybody who doesn't already know me, I am a commercial management accountant who spent 20 years in industry before, having been made redundant 3 times, decided to start an accountancy practice. I mostly, whilst working in industry, worked in manufacturing. I'm mostly in food manufacturing, and mostly chocolate, in fairness, but I do like a bit of chocolate, so there's nothing wrong with seeing how it's made, and they generally have a great factory shop. So when I started the business, some 16 years ago now, I wanted to bring the kinds of support that I was giving to industry, to those big businesses, to smaller businesses, so that the accounting practice would do more than just give people a tax return at the year end and a tax bill to go with it. So rather than just doing that, which is obviously a compliance thing, I wanted to be able to support people in their aspirations for their business and help them to grow. Consequently, and also because actually filing tax returns I find really boring, I've got a team of 12. So those people are great at doing tax returns, and actually the idea of doing something like this would scare them half to death. So we all play to our strengths. We've got a great team with all different experience and levels of qualification to satisfy the needs of whoever it is that might come our way. So what are we going to be talking about today? Responsibilities, red tape, and legal rules. So, it's not surprising that this hasn't had as much of an uptake of some of the other ones that I'm doing, because sometimes you just don't want to know. You just don't want to know. Or you need to know, but you never find the time to do this thing because this thing isn't growing your business. But it really could help, like a bit like an insurance policy. It really could help keep you on the straight and narrow and stopping you straying from the path so that you don't end up with a big mess to sort out later. So think of it like that. This is an investment in your business, a bit like an insurance policy would be, because it keeps you on the straight and narrow. So what are we going to talk about today? We're going to talk about the duties that directors have. So if you've got a limited company, if you're a director, and that's not a job title director, but that's a director on Companies House, you've got certain duties. One of those duties is keeping records and doing your taxes, etc. We're going to talk about that. We're going to talk about the money that the business earns and sitting in the business bank account and what you can and can't do with that. We're going to talk about your responsibilities from a VAT perspective as a company director and business owner, employing people. It's a bit of a whistle-stop tour, is this? So I'm not going into massive amounts of depth on any of it because we don't have time within the time restraints we've got today. Insurances, like actual insurances, rather than this being an investment that's a bit like an insurance, actually with an insurance company, and other responsibilities. So you've got a business, you start a limited company and you incorporate it on Companies House, and there you go, you've got a business. Typically, our clients are an owner because they're a shareholder. They're a director. You need at least one director on Companies House who has then the director's responsibilities, but there can be multiple. It used to be that there needed to be at least two, but now you only need the one. And for most people, they're also an employee. So you wouldn't be a contracted employee, but you would be an employee. You'd be on the payroll because you've got responsibilities within the business, but you also want to use your personal allowance for tax reasons. And some of your time might be spent working in the business, and some of your time might be spent working on the business at a more strategic level. And whether or not you're on the payroll typically would depend on your earnings from other sources and using that that personal allowance or what the other shareholders are doing. And so there's different rules for when you would be, or not necessarily rules, but kind of guidance on when it's a good idea from a tax mitigation perspective. If you're a shareholder, then it means you've invested in the business. People do think that you're all of these things or none of these things, but you can be one of these things. You can be just a shareholder, but not an employee or director. You can be just an employee, obviously, if you've got teams, you know that, and you can be just a director. And also directors, it can be just a job title. When I worked in industry, the next promotion that I would have been looking at would have been FD. Well, I wouldn't have been on Companies House as a director. That would have just been a job title. So job titles are different to responsibilities given if you are a director as per Companies House. So watch for that, but you do need at least one on Companies House. So the chances are that's you, which is why you're here today, because you want to know what that means. So director's duties. Typically, a director would be in charge of managing the company's business, and that would be at a strategic level. But you also might be doing things at an operational level. Depends how big your business is. You know, if your business is just you're the only director and that's it, you've got no employees, well, chances are you're doing everything. Well, you're doing everything that you haven't outsourced. So you'll be doing things that are operational and strategic, but you also need to meet your statutory obligations. So, director's duties. You are expected to act within the powers of the business. What does that even mean? So if you look up director's duties, it'll say you've got to act within the powers. Each business has got a specific purpose. Now, if you incorporated your business with Companies House and you didn't specify anything special, then you will have taken the generic memorandum and articles off of Companies House. And they are pretty generic. They tell you what your statutory duties are, but they typically will just say that the purpose of the business is to trade. So you can do whatever you want within that business as long as it meets your duties and isn't illegal, but there's no clipping of your wings. There's no restriction as to what the trade is. When you went on Companies House, you would have given it an SIC code, and that would tell anybody looking on Companies House the kind of trade that you do, but you can have multiple trades. And also you can change that over time. So your business could totally swerve off to the left or right at any point in time, and your memorandum and articles wouldn't stop you from doing that. But some businesses have got quite a specific purpose. If you imagine like a CIC, a community interests business, they have to state their purpose when the business is incorporated. And that is what you then have to do. It has got a specific purpose. And if you've got a bigger business and you've got some investors who've invested in your business and they're just shareholders, but they're not decision makers and they're not operational and they're not working on the strategy of your business, they're going to be looking to, well, what is the purpose of your business before they invested? So if you start swerving to the left and swerving to the right, that might not be a business they wanted to invest in. So the first thing, the first duty of a director is to act within those powers. And what that means is, whatever it was that you stated right at the beginning, the purpose of the business was. And for anybody who's thinking, I don't know what I said, the chances are it's generic. So the next duty that you have as a director is to promote the success of that company. Now, if you are 100% shareholder in your company, then it kind of goes without saying, doesn't it? But not everybody is. So what you're expected to do is act in a way that will promote the success of your company to the benefit of all of its members. So if you've got multiple members, multiple shareholders, then what you do as a director has to benefit all of them. And you have to, at the very least, try to make it successful. And this is often known as the Section 172 rule. So if ever somebody, when you're out networking or whatever, whittling on and they talk about the Section 172 rule, this is what they're talking about. And some people, they love to use jargon and try and blind you with something that they think, oh, you're never going to know what that is. Well, this is what they're talking about. So if you're always kind of doing the right thing and you're always looking to promote the business and make it more successful, then you're unlikely to stray from this particular rule. But one of the things that is kind of almost an unwritten rule is that within that, you need to consider relationships with suppliers, and you need to think about the impact your business has on the environment and things like that. And also, you know, you do hear sometimes bigger companies typically getting into bother, getting criticised because they've prioritised one aspect of their business over another. And this rule can sometimes come into play for that. So there is just, you know, while we're talking about it, the Institute of Directors have brought out a code of conduct, and it kind of talks about this. And there's the 6 core principles of a director's conduct, and this is what they are. And it's guidance rather than an actual director's duty, an actual rule. But actually, isn't this just like a really good set of rules to run your business by? And potentially your life, really. I mean, I don't think there's anything surprising or earth-shattering there. So they're basically saying, be a decent person and be fair to everybody with a bit of integrity and don't hide. No. And actually, I just don't think you can go far wrong with that as a principle within your life as well as within your business. What they're saying is that within their guidance, that this is not just for the business, but also for society, for communities, and for the environment, and promoting higher standards in the supply chain, and, you know, considering your impact on the wider business community and society and environment and all that kind of thing. So yeah, so that's what they're saying on the matter. So the next rule is to exercise independent judgment, to make your own decisions. And that those decisions that you make are in the best interest of the company. So all these rules are kind of interdependent. You know, I've got an A level in maths. Let's bring that out. if we talk Venn diagrams, there would be an intersection. I know when we do maths at school, we're looking at Venn diagrams and going, I ain't ever going to use that once I leave this class. Honestly, Venn diagrams, imagine a Venn diagram. These rules, they do intersect. So this one has got a nod back to the other one with the best interests of the company. But it also is about not favouring one shareholder over another shareholder or group of shareholders or investors' interests and things like that. Making your own decisions, well, it's a good idea anyway, because you're going to be held accountable for them, aren't you? Because you're a director. So I'm a big fan of making my own decisions personally. But that's one of the duties of a director anyway. So exercising reasonable care, skill and diligence to carry out your role. So what is your role? The first thing you need to work out is, what is your role? What is it that you do in the business? And for anything that you do in the business, whether operationally or strategically, do you have the skills to carry out that role? So that's particularly important in aspects of tax. If you can't say, I didn't know that wasn't a tax deductible expense, that I couldn't do things in that way. It's not an excuse. You're expected to employ a competent professional. But it isn't only with aspects of tax. We do the accounts for charities, and there are certain legislations that charities need to adhere to. And if the directors, well, there wouldn't necessarily be directors within a charity, but if that board doesn't have the skills, doesn't have the knowledge, doesn't have the ability, therefore, to carry out their roles and duties with reasonable skill, care, and diligence, they need to bring somebody on there who can guide them in that, or outsource it to a third party. So you can delegate it to somebody within your team. You might employ somebody who has got that knowledge, that skill, or you can outsource it, but your company needs to be able to exercise with reasonable care and skill and diligence, whatever it is that they're doing. And this is your duty to make sure that that happens. So that's that one. Avoiding conflicts of interest. Now, this is an interesting one. I have to be very aware of this. So we, as part of the fact that we are regulated by an accounting body, we have to do all sorts of things within that. And not only me, but all of my team have to do a declaration about whether or not they know personally any of our clients, because they could then have a conflict of interest. If they're doing their tax return, they could be in collusion with them in some way. So we have to be very mindful of things like that because of our profession. But every director has this duty, and it goes wider than just that. So you need to avoid exploitation of anyone that's within your sphere of control or influence. But you also need to consider the implications of if you've got multiple directorships. So if you are the director of multiple companies, does that represent a conflict of interest in some way? Would you favour one over the other at the detriment to another? Because your duties are the same in all of these, and you need to be furthering the best interests of all of them. So maybe you can't be the director of multiple companies if there is a chance that that would lead to a conflict of interest. And that goes the same for advisory positions. If you've got multiple advisory positions, you need to question whether being an advisor for that particular company could be perceived as having a negative implication on another company that you've also got an advisory position with. And you need to be really careful about insider knowledge. So when we're a director of a business, we've got all sorts of very commercially sensitive knowledge about that business and its dealings and the tenders it's put out and the suppliers it's got and the clients that it's got. all sorts of different things. And we need to be careful that we don't use that in the wrong way, that is to the detriment of the business, or to create an opportunity that's good for you, but not necessarily good for the company that you're a director of. So this one, it's quite easy, I think, to fall foul of if you don't seriously consider it on a regular basis. And you really need to consider that when it's connected persons. So this could be a family tie. This could be a distant cousin or your next door neighbour, or, you know, your mum's got a business and you're trying to help her out, or whatever it is. You know, connected people often tug on our heartstrings and we want to help them out for one reason or another, but we need to be really mindful of whether or not we're exploiting them or they're exploiting us, and that actually that is a conflict of interest because it doesn't further the betterment of this business that you're a director of. Benefits received because you are a director. So we need to consider this in relation to directors' duties, but we also need to consider the Briberies Act. So best bet is just don't accept them, because it's just really black and white then, isn't it? You know, you have to be careful if you receive a Christmas gift. It could be as little as a bottle of wine. But if somebody perceives that that is giving somebody a benefit in some way, that they are going to get a discount off their bill, that they're going to win a contract over somebody else because they took you out to the golf or whatever it was, then it could be that you're falling foul of something within the Briberies Act of 2010, or your director's duties. So if you receive a benefit because you're a director, either you could say no, or what I do is, so at Christmas, we do get some lovely clients and some people who we work with who will bring in lovely things into the office. And we put them all under the Christmas tree and we raffle them off to all the team at Christmas. They come with my name on, but I don't get them. Therefore, I'm not getting any benefits by virtue of the fact that I'm the director, I'm the named person who runs the business. Everyone in the business gets a benefit from those gifts. And I also think that that goes back to that fairness principle, doesn't it? You know, if you're answering the phones in my business, the chances are nobody's ever going to give you a Christmas gift because you were polite when you answered the phone. But if I've helped you with the strategic direction of your business, or I've helped your business to grow, or I've saved you tax or whatever, then that might, in somebody's mind, warrant bringing in a bit of something nice in at Christmas. So, and I want everyone to feel that whatever we do is fair. So if you just keep everything fair, then that's fab. I've also heard of other people who make a donation to charity. So either if somebody's taking you to golf, you know, make a donation to charity because you're getting that for free. Or those gifts that come in, give those to charity, re-gift them to charity. Somebody's getting a benefit of it, but it can't ever be that anyone perceives that you've received an undue benefit just because you were a director. So the Briberies Act, another piece of fun legislation. I think authorising a bribe to secure a contract, you'd see that that was wrong. You'd see that that was wrong. I mean, it's got like big red flags all over it, hasn't it? I mean, I think the Christmas gifting is a little bit under the table and we might fall foul of that without realising that we were. But if you are, in fact, authorising a bribe, then, and that's securing a contract, then you know you're stepping over the line. And if you're the kind of person who does that, chances are you're not on this webinar because you wouldn't want somebody like me telling you that it's wrong, because those kinds of people do tend to bury their head in the sand. But also things like whistleblowing. So that whole ability that somebody within your team, if they see something is wrong, should be allowed to declare that it's wrong without there being any undue impact on them. And if it's a bigger company, then there should be a whistleblowing hotline, but people should be able to say that they've seen something and it wasn't right. And if they do tell you that they've seen something and they didn't think it was right, then you shouldn't ignore them. You need to listen to that. And if it was wrong, then you need to sort it out. So yeah, and also if you're aware of bribery going on, then it's your duty to prevent it. So you might be the whistleblower. And also if you're not looking at this and going, I'm horrified, I don't understand why anybody would do any of that. Hopefully the threat of criminal prosecution, the potential of criminal prosecution would deter you from doing anything like that. People do it though, don't they? So declaring any interest. So, again, interlinked with some of the other ones that we've talked about. But if you do have an interest with a connected party, with someone who it could be perceived you've got a conflict of interest, then you need to declare it. You need to declare it to your co-directors, and you need to declare it to them. So if you think that by acting for them, you could be creating a conflict of interest between their business and their role in their business, where they have to look after the interests of that business, you have to tell them that there is a potential conflict of interest. And that can be for anything that is existing and occurs now, and you may already have that relationship in place, or something that is proposed to be acting. It might not be your decision to go into that relationship that you think might cause a conflict of interest. So it's your responsibility to declare that and make sure that everybody is aware. So other duties are things like confidentiality. We talked about the fact that you have got access to all sorts of very commercially sensitive information if you are a director of a business. But you've also got a health and safety obligation, a duty of care to yourself, your team, and anyone else who comes onto your premises. And if you're going out to other people's premises, you've got a duty to health and safety of anyone who you come into contact with. And this is like Christmas do's and everything. I mean, health and safety is a full-on minefield. And if you're in any way worried about what you need to do within health and safety, then you should very much get somebody who is an expert in that area to come and talk to you and, help you with risk assessments and just the mitigation of risk. Nobody comes to work to be injured, including yourself. And we all have a duty of care to everyone. Well, just generally in life, if somebody was about to walk into the road and you saw a car coming, you'd stop them, wouldn't you? And it's just that, it's an extension of that, but with responsibility for it sitting behind it when you're a director of a business. The environment, we're expected to consider the environment in everything that we do, and we need to avoid corruption. I mean, again, back to the fact that we're legislated on all sorts of stuff like this and regulated. So we do need to look at anti-money laundering and anti-corruption, just as the day job. But we all, as directors, have a duty to consider that and be that whistleblower if we need to be. So other than the Briberies Act with that risk of imprisonment, there are some other aspects of directors' duties that can have really significant consequences, especially if you get into an insolvency situation. So in the last year to 18 months, the level of business insolvency has gone through the roof. And this is a lot of the time because people, they lost all of their reserves and a lot of their resilience through lockdown and took out big business loans to get them through lockdown. And then the economy since then, well, it hasn't been great. It hasn't been great. It's tough. It's tough out there. So lots of businesses have just gotten to the end of the line and they've wound up for one reason or another. And it's something that you can do, and it's something that people have to consider from time to time. It's awful, but it's a thing that happens. It's a thing that happens. So you need to be mindful that if you are ever going to go through an insolvency process, that you can be deemed personally liable for the debts of the business as a director. And that isn't always because of the obvious things like signing a personal guarantee on a loan. You could be deemed personally liable if, for example, you took out your, let's say it isn't that profitable, therefore you couldn't take dividends, but you were still taking money in lieu of dividends via a director's loan. So you'd got a big overdrawn director's loan account and you were taking the money out, thank you very much, but you couldn't afford to pay your creditors. So the people who'd provided goods and services to you in your business are not getting paid, but you're taking money out of the business. It could be actually that you've got multiple creditors and that you've favoured one over another. That can make you personally liable. You can't favour one creditor over another. What you can do in that situation is, if you've got somebody who's on the phone to you daily, or saying that they're going to stop supply of whatever it is that you get from them, and you paid them, but you didn't pay somebody else, then there are reasons why you paid them rather than somebody else. And it wasn't necessarily on due date that you paid everybody, and it doesn't necessarily have to be on due date that you pay everyone, but you need to avoid any kind of preference for one creditor over another that isn't defensible. So think about why you're doing it, and it's back to that conflict of interest. It's back to that associated persons. If there is something in it for you that means you pay that person rather than that person, then that is preferential over one creditor over another, and that's going to lead you down the wrong path. And that whole taking out money, overdrawn director's loan account, but you can't afford to pay your creditors. Now, if you're in a business that is struggling and you can't afford to pay yourself dividend, or the business can't pay you dividend because you haven't made a profit, I would strongly advise that as soon as that occurs, that you think about taking salary rather than dividend for the work that you do in the business. You're still working in that business. You are a role holder of some description. You might be doing operational things. You are doing strategic things. You're entitled to be paid. But if you take that out as an overdrawn director's loan, then you're going to be asked to pay it back during the insolvency process. Whereas if you pay yourself a salary and pay the taxes and deductions on that, then you're less likely to get into trouble. So if your business is struggling, if it's not making profit, if it's unlikely to make profit in the near future, then think about that whole salary versus directors' loan accounts just getting more and more overdrawn. Because if it all does go pear-shaped, if you with all the will in the world, you thought you could trade your way out of it, and then something happens, and it might be a supply, it might be one of your customers who goes under, and now you've got a big bad debt or something like that, and then suddenly it's not looking good on paper. So look after yourself, protect the position that you're in, speak to your accountant if you think that you might be deemed to be trading insolvent, and potentially speak to an insolvency practitioner. Understand what your duties are and how you could be acting outside of those in an insolvency situation without even realizing that you are. So, oh yeah, and also other people could start an insolvency process on your business. So for most businesses, they would start the process themselves when they've gotten to a point where they think, well, I don't have anywhere to turn at this point. I can't see us trading our way out of this. Our debts are too high. Whatever it might be, they would then go and see an insolvency person, insolvency expert, and they would lead them through that process. But actually, if you owe a lot of money to your creditors and you're not paying them, if they don't believe that they're going to get paid, they can actually start an insolvency process on you. As can Companies House. They can start, they'll throw a gazette out as easy as you like these days. If you've not done your confirmation statement or filed your accounts on time, they're straight in with the first gazette. And HMRC, you know, if you owe them a lot of money, then if they don't believe that they're going to get that money out of you, they'll start an insolvency process on you. The difference between somebody else doing an insolvency process and you doing an insolvency process is if you do it, you're going to have to pay. And where's the money coming from? Because, you know, we've just said the business is not doing that well. That's why we're doing it in the first place. And you're going to have to pay the insolvency practitioner to do their job. You don't pay if somebody else is doing it because they're the one who did the instruction. But they're not going to be on your side. So there are things that they can do, there are ways that they can look at your data that can be slightly in your favour, whereas they're just going to come straight out with all the teeth and not listen to a word that you say if somebody else is doing it. So you'd rather, I would suggest, pay somebody to do that and get your ducks in a nice row rather than somebody else coming and kicking your ducks all over the place. And that's the difference between the two. You are much more likely to get a better outcome for yourself and the business if you instruct a professional than if somebody else does. So, obligations for accounting, bookkeeping and tax, my specialist area. So off you go, you decide that you're going to start your own business and you decide that you're going to have a limited company or one of the limited company vehicles, a CIC or something that's on Companies House. So the first thing you do is choose a name. Choose a name, has to be unique, and you do the process of incorporation with Companies House. And they will typically the next working day send you back, this is your company number and your certificate, the proud owner of a new limited company. And that is what incorporation is. They then dob you into HMRC. So they communicate with HMRC and tell HMRC that you have started a limited company. And then a couple of weeks later, HMRC will send a letter to your registered office saying that you are liable to corporation tax and that is the responsibility, the liability of that limited company. And of course, you're a director of that limited company, so very much your responsibility. We'll also give you your UTR, sometimes called unique tax reference, or anyway, it'll be on the letter. It'll be on the letter, and it is fairly obvious because you know that that's what you're looking for on there. So as soon as you know that's what you're looking for, you'll find it on there. Keep that letter anyway. Anyway, so you've now got some duties by virtue of being a director of a limited company to both Companies House and HMRC. So you've now got two further people, two further bodies that you have got to feed with information, meet deadlines, pay taxes, do what you're required to do under their rules and regulations. So the first one of those is record keeping. So your obligation as a business owner and director is to keep accurate records. And you need to keep those accurate records for 6 years plus the year that you're in. And you need to take reasonable care that these are correct. And if that means employing a competent professional to do that for you or getting software to support you with that, then that's the expectation on you to do that. If you're VAT registered, then you've got even more deadlines and you've got a responsibility to meet your deadlines. And to help you to meet your deadlines, HMRC and Companies House go with the stick approach. So to help you meet your deadlines, they are going to enforce penalties on you if you don't. And they can be quite a lot. I mean, if you've not done your self-assessment tax return yet, the deadline's midnight tomorrow night. And if you fail to meet that deadline, it's £100 straight away. And then it goes up another £100, and before you know it, you're into £1,000 or more. And all of these have got some form of penalty associated with them. And if you're not sure what they are, you can find them online or ask your accountant what they are. So what are the deadlines? So the deadlines for Companies House, the accounts need filing within 9 months of your year end. And your year end will automatically be the end of the month that you did the incorporation. So if you went on to Companies House today and you got your company number tomorrow, you would have a January year end for that company. You can change that. You can change it if you want to. It is not a complicated process. You can go with a short year, as short as you like, and you can go with a long year, but it's a maximum of 18 months on a long year. So you could change it to something. If you've got multiple businesses, you might want them all to have the same year end. You might change it because your business is very seasonal and you don't want to end up being hassled by your accountant right in the middle of your peak season. And then that's your excuse. I didn't come back to you. I ghosted you because I was far too busy and now you've got the penalties to pay. Move it. Move it to somewhere. Move it to, some people move it because their biggest customers are on, let's say, a calendar year. So they want it to be calendar year. So when anybody's talking about the year, everybody's talking about the same thing. So whatever it is that makes it easier for you, do that. Have that as your year end. And if it doesn't really matter, leave it as the one that was already there. And then there's a process that doesn't have to be gone through. So 9 months after the year end is the deadline. You have to file filleted, they're known as, accounts with Companies House. So it's a smaller version of your full accounts that you do for HMRC. There's all sorts of legislation about what you can and can't put on there. So you need to make sure that you comply with that. And if you don't meet the deadline and you are up to a month late, that's £150 of a penalty. If you're up to 3 months late, 375, up to 6 months, 750. If you're more than 6 months late, it's 1,500 quid. And if you're late this year by more than 6 months and you were also late last year, they double it. So anybody who is habitually late, they all get doubled. Now, you can, in certain circumstances, ask Companies House for an extension. And if they say yes, if they think your excuse, whatever it is that you said was the reason you needed an extension, is good enough, they'll give you another 3 months. They'll give you another 3 months. So, so they're the deadlines for filleted accounts. You also have to do a confirmation statement. So a confirmation statement is an annual declaration that nothing's changed. So the shareholders are all the same, the persons of significant control are all the same, the registered office is the same. All the things you put on when you incorporated the business, they're still the same. Nothing's changed in this last year. But interestingly, you have to do that and you have to pay for the privilege of doing it. But you actually have to make changes within, well, as low as 15 days for some of the changes. So if you change the name of your business, if you change the registered office, if you've got to change your shareholders, You can't wait for that confirmation statement. You actually have to make the changes in year and pretty quickly these days. You didn't always have to, but you do now. That is a requirement for you to do that. And Companies House have started that if you're late with your confirmation statement, or if you're late with your accounts, they're starting to put out a first gazette. So that's the starting of a winding up process. You can then obviously file the accounts, do the confirmation statement, and the dogs will go. The confirmation statement or the accounts will make the gazette come back off. But it doesn't actually stop it from appearing on the public record. And it doesn't look good. It doesn't look good if you've got a gazette. Anybody who's looking at your business, considering to be an employee or a supplier or a customer or whatever, they might look at that and go, you've got 9 months to get that in. Why didn't they do it? It suggests the business is out of control. So avoid gazettes at all costs because they sit there forever. Even if it stops, it sits there forever. And there's 2 records, one saying it started and one saying it stopped.
Sure,
So,
just quickly, somebody's asked a
yeah.
question in the chat, and I'm going to admit I don't know either. What's a gazette, please?
Okay, so the Gazette, it's a very old-fashioned term. So the Gazette is the London Gazette. So it's a newspaper. So if you think about the fact that in days gone by, we would put all deaths, all births, all marriages would all go in the newspaper. Well, all liquidations do too. And the reason why it goes in the Gazette, in the London Gazette, which you can get access to online, you don't have to buy the paper. But the Gazette means that it's telling everyone that your business is starting a liquidation process. So if they needed to know that for whatever reason, they can act accordingly. So it's letting people know. So the term Gazette kind of implies an actual newspaper with print that comes off on your fingers and all the rest of it. But it's kind of not like that anymore. But
So
the
it's just
term stayed.
in a paper of record sort of thing.
Yes,
It's just
it's on record. It's available for people to be aware of. So, for example, we use CreditSafe for all our credit checking of all our clients and suppliers and all that kind of thing. And we put on there that we want to be notified if anything changes. So we would be notified of a gazette. We don't have to buy a paper or anything like that. Because it's public record, it goes on to Companies House, we get told. And if you've got a personal guarantee with the bank, they'll be doing the same. You know, if you've got big suppliers, they're going to be doing the same. People would be aware that a gazette had gone out. Yeah. So deadlines from HMRC, many of these, depends how many taxes you've got, you know, how many plates are you spinning here? So if it's just a set of year-end accounts, the bizarre rules, I mean, these are bizarre. I mean, HMRC are a law unto themselves, but this is bizarre. You have actually got 12 months to file a CT 600. That is the tax return that companies file, a CT 600, 12 months. But we had to file a subset of those with Companies House within 9 months, and our liability to corporation tax is 9 months and 1 day after the year end. So what we're going to do, make that up, do it in the dark. I mean, how are we coming up with the amount of tax that we need to pay if we haven't done as accounts? It's madness. Just get it into your head, it's 9 months for everything. And it's 9 months for your self-assessment tax return, kind of, isn't it? Because the tax year ends on the 5th of April and you've got till the 31st of January. So that's kind of 9 months. Everything's 9 months. Just get it into your head that pretty much everything's 9 months, you won't go far. So, but the VAT return's slightly different to that. So it depends. You might be monthly, you might be quarterly, but all of those need to be filed 1 calendar month and 7 days after the VAT quarter end. Yeah. And then PAYE has to be paid over by the 22nd of the month following. So you run your RTI at the end of the month, let's say most people do, they run it at the end of the month. When do the deductions need to be paid over? by the 22nd of the month following. So also, though, bear in mind, with self-assessment, you've got payments on account. No payments on account for the limited company for the corporation tax, but if you've taken dividends and you've therefore done a self-assessment tax return by virtue of dividends or by virtue of trade or rental properties or whatever it is, just watch for those self-assessment payments on account. They catch people out, especially in the first year, because if you earn enough and you have to pay enough tax, you have to pay a payment on account. And if it's your first year, you've done your tax return, you've been muddling along for nearly 2 years and you haven't had to pay any tax. Suddenly you're having to pay tax on a year that was 9 months ago. And HMRC also want a payment on account for the year that you're in. So if we think about where we're sitting right now, the tax that is due by tomorrow is for the tax year 23-24. But we're already 9 months into 24-25. And that'll have to be paid in the January of the year. Well, no, they want their payment on account. So they want the payment on account for the year that you've already done 9 months trading in. You've already had 9 months worth of dividends for, whatever that might be. And that first year then, you've got 100% of the tax for that year, plus 50% again on account for the next year. And then you pay another 50% on account in the July. The great thing is once you're into that cycle, it spreads those payments because you're paying them twice a year. And if you're in a steady state and you're not growing, the amount of tax hasn't gone up, then you paid it in the January, you paid it in the July. There's a calculation to make sure that covers everything in the January. You pay it in the January, you pay it in the July. So it's only that once that you end up with that hockey stick impact of the big old tax bill. And then going on from that, it kind of smooths itself out. But you should be aware that if something changes, HMRC are always using historic data for your payments on account. So they're always saying, that's how much you paid last year. So we expect that that's how much you'll pay again the next year. If the next year doesn't look like the last year because you couldn't take as much dividend or because you don't any longer have the rental properties or the trade's gone down or whatever that is, and you're not going to make as much money. You're just not. You're allowed to reduce the payment on account. But buyer beware. You can do that. It's a given. If you ask for it, you get it. But if your tax then is more than you said it was going to be, on that reduction that you asked for, you have to pay interest on the difference. So can you reduce it? Yes, you can. Do you want to? Maybe, but just be careful when you do. And with all of these, just because this is where we're at within the year, if you're filing something and you can't afford to pay the tax, there is something called the Business Support Helpline, and you can phone them or do it online and ask for a time to pay arrangement. They then won't enforce penalties, but they will charge you interest. So if that's a situation you're in, please don't not file the return. Always file the return, get the return in on time. But if you can't afford to pay, all their systems update overnight. So it's best to do it one day and then ask them the next day. Otherwise, it's invisible to them and they think you've still not filed. But you can ask for a time to pay arrangement if you can't afford that tax. So money earned in the business. Well, it's mine, isn't it? I'm 100% shareholder and that's my business. So what's in its business bank account? Well, it's mine, isn't it? No, it's not. It's a separate legal entity. When you incorporated the business, you created a separate legal entity. And that was great because you got the limited liability, which means that if something untoward happens, it should stop, the book should stop with the company and not take your house. So you got that as part of creating a separate legal entity. But what that also means is that the money in the business bank account, and it legally needs to have a separate business bank account, the money in that account earned by the company is not yours. It could be yours if you extract it and deal with the tax on it in the right way, but it isn't yours just because it's there. It could be owed for tax, that money that's sitting in the business bank account. It could be owed to a creditor. So you can't just take it out just because it's there. So you can spend it on tax deductible expenses within the business, and you're the director, you can make those choices. But if you want it for yourself, for your Asda shopping or your holiday to Butlins, then you need to do it by one of the legal means of doing it. So those legal means of doing it are payroll. So payroll we've already mentioned a little bit. And payroll for most people who are directors and shareholders of businesses, if they don't have income from any other source, is what, number one, uses up your personal allowance, and number two, gets you your pension stamp. There's me showing my age again, using old terminology, pension stamp. It gives you the credit. You need a number of years of qualifying years to qualify for the state pension, and it gives you that by being on the payroll. So we would do that. There are certain circumstances when you'd pay yourself more. It might be that the business isn't profitable, but you still need to be paid for the job that you're doing. It may be that you're doing something that qualifies under R&D credits, research and development, and things that go through payroll that are activities that are to do with that research and development would qualify for R&D credits potentially. So sometimes people who are doing that would elevate their money through payroll. And also, if you've got multiple shareholders, it's unlikely that all the shareholders are equal. You know, what they do for the business to generate its profitability might not be the same. And if you've got the same number of shares, then you have to pay dividends per share. So if you get £5,000, they get £5,000. But actually, you might both deem that you've earned 15 grand. Well, you can do that through payroll. You can do that as a bonus through payroll because dividends are paid per share. So if you've got the same shares as another director, but actually you do something operational, you do something that's different to them, you can use payroll to affect that disparity between what you're both getting as dividends and what you're both doing. So payroll's the first one. Payroll must go through a payroll and be submitted to HMRC through RTI. You can't just put it in the nominal as payroll. It actually has to go through the system and go to HMRC as payroll for it to be a legal extraction for payroll. Expenses. If you worked for somebody else and you shelled out money in the name of the business, then you would expect to reclaim it. And that's exactly the same in your own business. There's no reason why you can't reclaim expenses that you incurred doing tax deductible activity. So most of the time, you would use the business's card. You know, you would pay it out of the business's bank account, you would use the business's credit card, whatever that is. But from time to time, let's say you're at a car park and it only takes cash. I mean, most of them these days, they're taking cards so you can use the company card. But if it was cash, then, you know, you're going to have to be repaid that cash. If you used your own vehicle to get to that car park and it was for the purposes of the business, then you can reclaim 45 pence a mile for the first 10,000 miles back against the business for that trip that you took. So you can take that, you can work it out, put it through and repay yourself as expenses. You can pay dividends. Dividends are payable, are legal as a profit less tax, whatever's left, that's available to be extracted as dividends. So that calculation kinda happens at the year end then, doesn't it? You've got a good idea. If you're profitable, you've got a good idea how much profit you're making potentially through the year. So you could take directors' loans in lieu of dividends. And that's often what people do. So they'll say, you know I'm going to make 50 grand this year. After tax, that's going to be close to 40. So I'm going to take 3 grand a month as dividends because I know that even though that'll be a director's loan during the year, there will be the tax deductible profit. pay the tax on that. At the end of the year, there'll still be enough to pay me that as a dividend. The dividend then gets issued, the dividend vouchers get issued, and that then reduces the director's loan in the director's loan account. If you get to the end of the year and you can't declare enough dividend to wipe out your director's loan, then you end up with an overdrawn director's loan account. You can take money out of your business as a director's loan, even if there isn't profit, but just watch that insolvency thing. But if you do take money out as a director's loan and it isn't converted to a dividend, then that needs declaring to HMRC, and there's tax that needs to be paid on that. It's called Section 455 tax, and it's over 30%. It's a big chunk of money. When you pay it back, when you pay the money back, the loan back to your business, that Section 455 comes back. But it doesn't happen as if by magic. All this stuff happens on the tax return. Therefore, it could be 18 months before you see that money back again. So it has to go on the next tax return after it's been repaid. Then it needs to get to the 9 months after the year end before it would be repaid. Or it could be reducing your corporation tax liability along the way. But the company pays that, not you. So you're taking money out. You've got an overdrawn director's loan account. The company pays a Section 455 tax. So that's fine. I don't need to worry about it. Except if my overdrawn director's loan is larger than £10,000. If it's more than £10,000, that now becomes a P11D benefit in kind because you've had an interest-free loan. And that isn't available to everybody, is it? Therefore, you should pay for that benefit. You pay the tax on that benefit. So a calculation needs to be done and a P11D needs to be submitted. So just watch for that. So these are the ways that we can extract money from our business, and we should do that in such a way that doesn't leave the business short and not able to pay its other liabilities. So, employing people. A minefield, especially with the new legislation that's coming in at the minute and has come in over recent years. So if you are already employing people or you're thinking of employing people, I strongly recommend that you engage the services of a HR professional. They're the ones who live and breathe this day in, day out, and they're the ones who can keep you out of a tribunal. So definitely make sure that you're complying with the legislation, and also, if you're not sure, speaking to a HR professional. Employees have got loads of legal rights, and it is your responsibility as a director of that business to ensure that they get their legal rights. They've got a legal right to many things, and this is not an exhaustive list because we would be here for hours going through that exhaustive list. But they include things like an employment contract, and you would be surprised just how many people who I speak to who don't have employment contracts for the people who are on their payroll. They are allowed to need to be paid the national minimum wage, and you can't make deductions from their pay for anything that drops them below the minimum wage. So you need to watch for that. You also need to watch for the Working Time Directive, and the Working Time Directive talks about how many hours in a week people can work, how many rest hours they get between shifts, and it also talks about holidays and how people are entitled to take holidays and should be encouraged to take holidays and be paid while they are off on holidays. And because we want to encourage people to take that rest time that is really good for their health and well-being, not only do we have to pay them under certain rules, but we also have to encourage them to take them. So we can't pay them in lieu of taking the holidays, even if that's what they want. We have to be really careful about things like that. There are certain circumstances when you can pay people holiday pay for time that they didn't take off. One of those is when they leave. But also if people are doing a chunk of work, let's say it was a university student and they work for you during the summer and then they're not going to be back till Christmas, but they didn't take any holidays and they didn't want to take any holidays. and you perhaps didn't want them to take any holidays either, you can pay them the holiday pay at the end of that chunk of work that they did, as long as there is a clear break and document everything that you do. They are entitled under auto-enrolment legislation to a pension contribution, to be in your company pension, and for you to contribute into that pension along with their contributions. You as a director could opt out of that if you wanted to. Your employees can opt out of it if they want to, but you cannot speak to them about it. You cannot be deemed to coerce them to opt out of that pension scheme. And here's another one with a threat of imprisonment if you do. So if you have got people who qualify and you auto-enroll them, they get put into the pension scheme, and Nest or Now or whoever it is that you're using, they will contact them directly and they will give them the ways that they can opt out should they choose to do so. And far less people do choose to opt out than we ever imagined would when this legislation came in. So you must comply with that. The pension regulator can be really helpful if you're not sure what you're doing, but has got a right old set of teeth on them. So just be careful of flouting their legislation. You need to check people have got the eligibility to work in the UK and keep records for all of that kind of thing. And if you employ anyone, you must have by law employers' liability insurance. And then we've got all sorts of other things like duty of care, and also, you know, it goes on and on and on and on and on. Please, please do look into this if you are thinking about taking anybody on or already do. So insurances, people will go, yeah, I've got insurance. Yeah, but is it fit for purpose? Because if your insurance was the cheapest one that you could get and you got it cheap because you didn't actually tell them what you really do, or you didn't update it and they've still got the historic stuff and they sent you the renewal through and you just went, yeah, I'll take it at that price, but you've doubled in size or whatever that is, it isn't fit for purpose. And if it isn't fit for purpose, it won't pay out should you have the need to make a claim. Therefore, whatever it was that you've paid an insurance company, you might as well burn in the street. So speak to a broker. Make sure that you get insurances for all the things that you need insurances for, and make sure that they are all fit for purpose. And what insurances you need will depend on what you do. So if you don't have buildings, you won't have to have buildings and contents insurance, goes without saying. But make sure that you have, you know, employer's liability if you've got anybody employed, public liability, professional liability. You know, if you've got anybody who goes to your premises or anything like that, make sure that you're covered. And then over and above that, you also have some choices of some insurances that you may want to have. And some of these, depending on how they're structured, can be tax deductible expenses for your business. So you might want to take out directors and officers insurance, which would pay like legal fees and things if you were to get a big legal case that came after you and the officers of the business because of one of the other slides that we've already gone through. Then this directors and officers insurance is there to protect you, to help to protect you. Relevant life can be to cover a person in the business who is a key stakeholder in the business, who you would need to replace if they were ill. So something like that can be put into place, and even shareholder insurance. So imagine there's 3 of you and you're all shareholders of the business and it all works really well and the business is profitable and everything's lovely. And you've got your shareholders agreement, and I would highly recommend everyone who shares a business with somebody has that. And in it, it says, as it rightly should, if one member of those shareholders dies, then those shares are bought back by the business or by one of the other shareholders at the market rate. And that market rate goes to the spouse or children or whoever is the beneficiary of that shareholders will, because that's part of their estate, isn't it? Where are you getting the money from? I mean, that's all fair and lovely. And of course, we want to do it. And of course, you would want your loved ones to receive it if you were that shareholder who had died. But where does the money come from? If you've done an arm's length valuation and they need 500,000 and the business ain't got 500,000 to buy it back, and neither of the other shareholders have got the wherewithal to buy it from them, but here you've got a grieving widow who's about to have her house repossessed, where are you getting the money from? We're getting the money from. So shareholders insurance covers that. So it's worth considering. But if you speak to an IFA, they can tell you all the things that you could get that are optional, but also tax deductible expenses. And they can guide you in which ones would be tax deductible and which ones wouldn't. So I'm sure you will be pleased to know that that is all I'm going to cover today, because it's a lot to take in and it's heavy stuff. But if you are wanting to know more about your numbers and financial management in your business, I'll be doing one on Tuesday next week at 10 o'clock. And here is the QR code to go through and register for that one if you haven't already. And now we've got some time for questions.
Thanks for that, Joe. I've also just put a link to those, the next week's in the chat, and the recordings from the previous 3 in the chat as well. Yeah, so as Joe says, we've got time for some questions, so I'll just stop the recording there if anyone wants to do any out loud questions.